Hello and welcome to this roughly about 15 to 20 minutes video presentation on the regulatory activity in terms of financial sector regulations in 2022. It's been a brisk year in terms of activity. A busy regulator kept all regulated entities even busier. The year marked the introduction of the new scale-based regulatory framework for non-banking finance companies, which obviously meant that there was a buzz in terms of understanding the new regulatory framework. The names of 16 upper layer entities were declared by the RBI, consisting of 5 housing finance companies, 10 investment and credit companies, and 1 core investment company. As I'm sure all of you know, depositing companies are taken to be upper layer entities under certain conditions. And as is the design, upper layer entities are treated at par with banks in terms of regulatory intensity. Hence, there is a large exposure framework as is applicable in case of banks, differential provisioning norms on standard assets, CET1, Common Equity Tier 1 requirement, as also the need for mandatory listing. As we noticed from the list of 16 entities, there is at least some entity or entities which are currently unlisted. These, in terms of regulatory changes, are those which affect compliances. But something that affected business in terms of the intensity and the severity in business impact, I would say the top prize goes to the guidelines on digital lending. The digital lending guidelines in September 2022 affected digital lending business. Digital fintech lenders were tangoing with banks and NBFCs. As one would imagine, originating loans doesn't require much of persuasion, as all you would need is someone who is willing to buy stuff that he doesn't need, under terms that he doesn't read, and with money that he doesn't have. So fintech platforms will divert these borrowers to banks and BFCs under a so-called sourcing partnership, providing a first loss default guarantee and sweeping the entire excess spread, which anyways was good enough to cover the losses. The DL guidelines appended the FLDG business. As a result, many of the sourcing partnerships were completely terminated, whereas some others turned themselves into co-lending arrangements. One wonders how long will that go to. The DL guidelines also provided for regulation of loan sourcing partners, which may indeed be unregulated entities. But for those loan sourcing partners, the regulated entities being the principals will be liable. There is a mandatory disclosure requirement for an all-inclusive annualized percentage rate inclusive of processing fees or anything else that is non-contingent by nature, a requirement for disclosing a key fact statement. There is also a cooling off period of at least 1 to 3 days, within which a borrower may exit the credit facility merely by paying the proportional annualized percentage rate without suffering a prepayment penalty. And importantly, a privacy policy has to be put in place whereby the access, sharing, or storing of customer data and information will be controlled. Microfinance regulations is yet another area where borrower protection seemed to be the major theme. So the entire shift of regulatory focus was shifted from entity regulation to activity regulation. Thus, microfinance loans, no matter originated by whom, including the so-called not-for-profit entities, will have to abide by the new directives. Thus, if a borrower under an unsecured loan has an annual household income not exceeding rupees 3 lakhs, he will qualify to be a microfinance borrower, in which case, while the interest rate itself is not regulated, except in case the microfinance entity wants to sell it off under a priority sector lending paradigm to a bank, the rates are not controlled, but the rates have to come from a board-approved policy. The debt servicing burden on the borrower cannot be more than 50% of the household income, inclusive of all microfinance loans the borrower might have taken. All the more, there is a substantial control on recoveries, including a discipline on physical visit to the residence of the borrower. The new scale-based regulatory framework for NBFCs is slowly sinking in. Tranches of regulations were announced throughout the year. The framework applicable to all NBFCs from 1st October 2022 has made major changes for middle layer entities and upper layer entities. Upper layer entities we discussed some time back, so I'll focus basically on middle layer entities. And as a part of this, the additional requirements, there's a requirement for a chief compliance officer. The UL entities have to appoint one by 1st April 2023. But the middle layer entities have a time till 1st October 2023. And the CCO appointed for a minimum of 3 years will be reporting to either the managing director or CEO or the board of directors or the audit committee. In addition, the company has to put in place a compliance framework. The major additional requirement of which is to have a independent compliance function, not necessarily independent compliance department, ensuring a strong compliance risk management program, etc. All of this have to be owned by the board of directors of the entity. Entities have to put in place restrictions on lending to directors, KMPs, senior management personnel, and the relatives, as well as entities in which directors or relatives are interested, thereby expanding the present regime applicable in case of related party transactions. Lending to director and related parties above a limit of rupees 5 crores will require the approval of the board, whereas lending within the limit will need to be reported back to the board. Further, if a loan is being given to an SMP or his relative, the SMP in question will neither be approving officer nor will he be a party to the approving committee. Compensation to key managerial personnel shall also abide by the new norms, which actually are effective from 1st April 2023. But in our view, that's just a transition time to adhere to the new requirement. And a major feature of the new requirement is that the long-term performance of the entity will not be compromised by performance-based variable remuneration. And wherever there's a variable pay, there'll be a provision for malus and clawback. Further, middle layer entities will also need to constitute a nomination and remuneration committee and comply with all the provisions of Companies Act in terms of the constitution, powers, functions, and duties of the nomination and remuneration committee. There's also a need for NBFCs having more than 10 fixed point service delivery units to put in place a core financial services solution, so-called CFSS. The objective is to make digital customer interface available and accessible 24/7 and provide a seamless interface, which includes all digital offerings and related transactions. Coming to asset reconstruction companies, there are 29 of them right now. They were the product of the SARFAESI Act, but got a major booster with the introduction of Insolvency Bankruptcy Code. The regulatory framework for ARCs was revamped with the new Master Circular of October 2022. The new requirements include the need for having independent directors, including the chairperson, who shall be an independent director as well, and the increase in net owned funds requirement from rupees 100 crores right now to rupees 200 crores by March 2024 and 300 crores by March 2026. However, the need for ARCs to infuse money in the security receipts created through them, and that's been significantly brought down by the new definition. Early requirement was 15% of the SRs need to be invested in by the ARC, but the revised requirement talks about 15% of the transferor's stake in the SRs or 2.5% of the total volume of SRs, whichever is higher. This will lead to a substantial reduction in the infusion of money that ARCs have to make in the SRs, thereby making more SRs available for investment by external investors. In terms of what assets can ARCs buy, there's a significant region to cheer once again, because as opposed to the original provisions of the TLA directions, which required the loans to be trailing by more than 60 days for ARCs to buy them, now the ARCs can buy any loan which is trailing even by 1 day. So any loan which is stress, meaning more than 0 DPD, can be bought by ARCs. Further, the requirement for continuation of provision in case the transferor continues to hold more than 10% stake in the SRs, that requirement was extended to non-banking finance companies as well, though the resulting diminution in value of SRs can be spread over a period of time. As for securitization and transfer of loan exposures, there were two changes recently in the month of December itself. The requirement of minimum holding period, MHP requirement, which is a unique feature of Indian regulations, that requirement was amended to run from the date of registration with SARSAI, except in case of those loans which are either unsecured or where registration with SARSAI is not even possible. In case of home loans and real estate loans, the minimum holding period shall run only from the date of completion of the disbursement. This is applicable in case of securitization and not in case of TLE. The RBI also suddenly showed a frown for short-term loans, and in case of securitization, prohibited securitization of any loan, the residual maturity of which is less than 365 days. Though there is no bar on transfer of such loans under bilateral assignments, but these loans cannot be added to a securitized pool. Coming to factoring regulations. Now, for no apparent reason, the regime for factoring continues to be unclear and restrictive. While the intent of amendment in the statute itself in 2021 was to move out of the condition of being a predominantly factoring entity, the RBI responded to the amendments, introducing a so-called certificate of registration requirement, which will need an asset base of rupees 1,000 crores at least, and of course satisfaction of other conditions. Those other conditions include a clean regulatory track record, almost putting entities to a virtual licensing regime. One wonders how many NBFCs would have applied to the RBI and have been granted the certificate of registration for factoring business. Moving to overseas direct investment regime, the new set of ODI rules and directions was issued in August 2022. The new rules make a distinction between overseas portfolio investment and overseas direct investment, while the former, which is overseas portfolio investment, includes any minority investment in listed entities, and investment in unlisted companies or holding a control over listed companies, where definition of control being significantly changed. That is what would count as overseas direct investment. In terms of defining control, the definition of control now includes 10% or more of the voting power in the entity, which is significantly different from the way we understand control under the Companies Act. Further, round tripping, which was earlier under a regulatory shadow of doubt, round tripping is now possible, provided round tripping is for bona fide business purposes, and the investee entity is not, doesn't have more than 2 layers of investment in the country. Those having non-performing assets, NPA accounts, or those who have been declared as willful defaulters, they will not be permitted to make overseas investment, including overseas portfolio investment, without the NOC of the regulator. There's also been significant relaxation in overseas direct investment in financial sector. As for credit cards, for the first time, the word credit card has been defined in the new credit card regulations to mean a physical or virtual payment instrument containing a means of identification issued with a pre-approved revolving line of credit, which means the important feature is the line of credit has to be revolving, and it has to be a line of credit which is pre-approved, which can be used to purchase goods or services or to draw cash, subject to terms and conditions. The new directions for issuance of credit and debit cards lay down general guidance and conduct of issuing entities, which now specifically includes non-banking finance companies as well. For NBFCs to be eligible to issue credit cards, they must have a net own funds of rupees 100 crores, and they can only issue credit cards after regulatory approval. Another important clarification or communication of the RBI, which is 20th June 2022, restricted the loading of prepaid instruments, PPIs, with credit lines. That would mean a PPI cannot be loaded with a credit facility. It has to be loaded with money from the borrower's own account. Coming to the very sensitive topic of cryptocurrencies, the RBI's disapproval of private cryptos was always vocal. It has now got force with the debacle of FTX in the US. No one can oppose the RBI when it comes to private cryptos, but in the meantime, central bank digital currency CBDCs, as per the plans, the RBI has debuted CBDCs on a pilot basis, both for wholesale transactions, which means banks to banks, as also for retail transactions. It almost seems certain that CBDCs will soon be launched in the country. And from what it appears as of now, with the full benefit of anonymity, which is the key feature of any currency. With this, thank you for watching this short video and wish you a very, very happy 2023.